So Ray Dalio thinks that the whole US stock market, including your retirement, your 401k, your portfolio, is running on borrowed time.
Are you seeing signs that we're in an AI bubble and therefore a economic collapse?
The classic signs, and that has implications for the economy, and it's bad for the society, and everybody loses money.
I agree with him, and I'm confident that you will too by the end of this video. But the thing that might surprise you is that he hasn't sold a thing, which to most people makes no sense. If it's a bubble, you get out. If it isn't, you stay in, right? But that mentality of being either all in on the AI bubble or all in on cash is how you lose money. Dalio isn't doing either of those. Neither is Buffett, neither is anyone else who wants to protect their portfolio. So today I'll break down Ray Dalio's 90-minute interview with Stephen Bartlett. I watched the whole thing, so you don't have to. I'll break down what Dalio actually said about the AI bubble, how it impacts your portfolio, how to play it right, and what I'm doing with my own money. So let's figure this out together. So Ray Dalio is often framed as a doomer, and he doesn't get the respect I think he deserves. So let me tell you a bit about him, because I think he's up there with Warren Buffett as one of the best investors of all time. Dalio started an investment firm called Bridgewater in a 2-bedroom flat in 1975. Then in 1991, Bridgewater launched Pure Alpha, its flagship hedge fund, which went on to become one of the biggest hedge funds in the world. A hedge fund, if you've not come across the term, is just a firm that manages money for very rich people and very big institutions and gets paid a slice of whatever it makes them. Bridgewater has generated roughly $57 billion in net gains for its investors over its history. But Dalio's track record is what stands out to an investor though, and I'll tell you why. If you invest in the S&P 500, you make money in a rally and you lose money in a crash. And in a crash year, you could lose big, 20, 30, or even 50% in one of the really bad ones. Invest with Bridgewater though, and even in a brutal year for the stock market, you might make 9% or more. I'll give you one example. One of his biggest achievements was 2008 when the S&P 500 fell almost 40%. Bridgewater made 9.5% for its clients that year. This is because of Dalio's famous approach to markets. He builds portfolios designed to do well whatever the market throws at them, and they've been battle tested for decades. One example is his all-weather portfolio, which we'll talk about later, but as a quick side note, an all-weather portfolio is important as you get closer to retirement because you can't afford a 50% wipeout as you don't have 20 years to recover from that. Look at the NASDAQ in the dot-com bubble. It lost 78% and took 15 years to recover. If you were 55 when that happened, bye-bye retirement fund. I have my own version of an all-weather portfolio suited to my needs. I'll talk about it a bit more later. Now let's talk about what he said the other day when he was interviewed by Stephen Bartlett, who does the Diary of a CEO podcast. Bartlett plays Dalio a clip. Watch what Dalio says.
If you look at the data, it would be compatible with history for the peak to be very soon. Everything is in line. This is, I think, the biggest investment bubble in American history.
What's your perspective on that?
He's right.
So that clip was Jeremy Grantham, by the way. He runs an investment firm called GMO, and he has an impressive track record himself. I mean, this guy called the dot-com bubble in 2000, the global financial crisis in 2008, even the Japanese bubble back in the 80s, insane track record, and an underrated all-time great at spotting major asset bubbles. And Dalio just says straight up, he's right. The biggest investment bubble in American history, and Dalio, one of the few who made money in 2008, just agrees and carries on. But it's what he says a bit later that actually matters.
Are you seeing signs that we're in a bubble?
Yeah. The classic signs that we're in. And the bubble, I should emphasize, it's not a you're in a bubble or you're not in a bubble. It's a degree thing.
Now, this is something I 100% agree with, by the way, and it's one of the biggest problems in how this stuff gets talked about. When you talk about the AI bubble, it's always black and white. Either you're all in or you're all out. And this is the worst way to think about markets. The greatest investors don't think about markets in this way. Not Dalio, not Buffett, not Grantham, not even just them. Peter Lynch, who ran the best mutual fund on earth through the 80s, never thought about the market in this way. Jim Simmons, the mathematician who built the most profitable trading firm in history, never thought this way either. None of them are all in or all out on markets at any point. And if the bubble itself is a matter of degrees, like Dalio said, then what you do about it has to be a matter of degrees too. So the way I like to think about it is this. Picture a slider. All the way out on the left, that's every penny in cash. You have nothing in the markets. All the way in is on the right. That's every penny in the market. Nobody spends a whole career at either end. You sit somewhere between and you move along it as things change. So sometimes you're further right, sometimes you're further left. Right now, I'm around here, wherever it is. The editor will put it up on screen. A little bit to the right of center. I have more money in the market than I have cash at the moment. And I'll explain a bit more about this later. But the point is, a bearish outlook doesn't mean zero, and a bullish outlook doesn't mean everything is in right now. So keep the slider in your head, because I'll talk about that more as we dissect Dalio's portfolio and my portfolio, etc. And by the way, there's one more thing Dalio said that is really important. You really need to hear this. He said Nick has a free guide on how to retire by 2036. There's a link to it below, and you get his free weekly newsletter with it. Just chuck in your email. All right, he didn't actually say that, but the free guide is there. Just click on the link and throw in your email, grab it. It's all free and it's really good. Right, so what does Dalio actually mean when he says bubble? Because people throw that word around and it means like a bunch of different things. Here's his definition in his own words.
What they call a bubble is when the price goes up a lot and companies do very well, and then it collapses. And that has implications for the economy, that has implications for the markets, like 1929 bubble, okay, or the 2000 bubble.
There you go, dead simple. The price goes up a lot, the companies actually do well, and then it collapses. Notice what's missing there though. He's not saying that the technology is fake. He's actually on record saying AI is revolutionary and that we should be excited about it. What goes wrong isn't the technology, it's that people stop looking at what they're paying for the technology. And let me show you what that looks like, because it's happened before, and both times everyone was right about the tech. So we'll start with 1929 first. In the 1920s, everything arrived at once. Electricity turning up in ordinary houses, cars that a normal family could finally afford, airplanes, radio, everything was just happening. And every single one of those things did change the world. The people buying in were not wrong about the tech. They were wrong about the price. And the market fell 89% from the top, and the Great Depression followed. And back then, there were people just like now saying, this is revolutionary technology, you don't understand, bro. But they probably didn't say bro back then. It's just going to keep going up, the world's changing. But the bubble always bursts. Then the year 2000, that's the other example. The internet was real. Obviously it was real. You're watching this video on the internet right now. But most of the companies weren't making any money. And the NASDAQ, which is packed with tech companies, that's what the NASDAQ is essentially. It's an index of tech companies. It went on to lose 78%. And I know people are going to say, well, this time is different because the AI companies actually make money. I'm not disputing that, to be honest, but that doesn't change the fact that they can still be overvalued. In 2000, many companies had revenues of, let's say, a few million and market valuations of a few billion. Today, the biggest AI companies have revenues of tens of billions and market valuations of over $1 trillion for some of them, which is obscene. So we can still get a 2000 style crash. And a lot of people don't know this bit. When the NASDAQ crashed, it did not come back to its all-time high for 15 years. So imagine you bought the top of that bubble. And as always, this bubble never hurt Wall Street traders. It never does. It hurt people like me and like you, 40s, 50s, 60s, growing a retirement portfolio. Anyone who was unfortunate enough to put money in the NASDAQ near the top had to wait 15 years just for it to come back to break even. Not really a position I'd want to be in if I was 55 years old. So when a big, but honestly, it's not even a position that I'd want to be in if I was 40 years old. Anyway, so when a big bubble pops, it's a serious thing. And right now, it's our pensions and our index funds holding this one up. So what is Dalio actually pointing at when he says the signs are here?
And is it in strong hands or weak hands? Classic strong hands is that when weak investors, not knowledgeable investors, then put a lot of money into it, particularly if that's in a leveraged way.
In a way with debt.
With debt.
All right, so let me translate Wall Street Grandpa for you. These are the three signs that Dalio talks about through this interview. One is prices that have come away from what the company actually earns. In other words, overvaluation. So a company like SpaceX loses money, so it earns $0, and it has a valuation of over $1 trillion. That just makes no sense, but it's just reality. Two is inexperienced money piling in. And again, we can use SpaceX as a recent, very fitting example of this. The amount of inexperienced retail traders that piled in when it was worth $220 per share, and now it's lost like 50% of its value, that's inexperienced money. The experienced guys, the insiders, they are the ones who sold at $220 and dropped the price of SpaceX. And three is borrowed money everywhere. And this is the important one, really. Now, I want to focus on borrowed money because it's the one that does the most damage. The market is currently propped up by $1.53 trillion of borrowed money. That's an absolute obscene amount of money. But why does this cause a crash? Well, Think about it like this. The number in your stock portfolio isn't money. It's just a price. It's what somebody would pay you today if you sold your stocks to them. Here's how it works. When you open up a brokerage account, your broker offers to lend you money to buy more stock, usually at a 2-to-1 ratio. So for every $100 you put in, they lend you an extra $100, so you're holding $200 worth of stock. You can elect not to do this, and I'm sure most of you do not trade with leverage, but this is how leverage works. So this works brilliantly on the way up. The market rises 30%, your $200 becomes $260, and you've made $60 on 100 of your own money, a 60% return. Amazing, you're a genius. But now when you run it backwards, the market drops 30%, your 200 is now worth 140. The $100 you borrowed is still just $100. So your own money is down to $40 because you owe the broker $100. Right? You are down 60% on your own money. But there's another catch, and it's called margin. See, that $100 your broker lends you, it doesn't want to lose that money if the market crashes because it's their money, right? So it makes you keep a little bit of a buffer in your account. That's called a margin requirement. It's usually 35%. So taking that $140 example that we were using, if you have $140 left on your account when it's gone down, 35% of that is $49. But you only have $40 of your own money left in the account. Oopsie, you get a margin call, which means your position is forced sold at market price right now. It's not only you that experiences this though. In a market crash, this happens to millions of traders at once, and that forced selling makes the entire market crash. This is called a margin cascade, and we saw this recently in South Korea with the KOSPI, K-O-S-P-I. The KOSPI is essentially an index of the South Korean market. It's like the South Korean version of the S&P 500. Over the last few weeks, a margin cascade unfolded there, and the KOSPI crashed 43%. Hundreds of thousands of inexperienced retail investors got completely wiped out, and millions lost a lot of money. So margin cascades really just start with a few people, and then it cascades into millions of people selling all at once as they get margin calls. And then you get a 43% crash like we saw with the KOSPI. But now the other question is, what makes those first people at the start of the cascade sell? Well, Dalio names two things: something that forces people to raise cash and a flood of new stock. The first one is usually interest rates going up. We all know how this one works. Interest rates go up, you need to pay more per month on your debt. You can't afford to, so you have to sell something. Oftentimes it's your entire house because you can't afford your mortgage anymore, so you have to get rid of your house. The second one is his best line in the whole interview.
So you can issue stock. It's very easy. There's almost nothing that's easier to produce than stock.
Think about that. If loads of people want to buy shares, companies can just make more shares. There's no shortage, there's no factory. Somebody just has to sign a form and create shares. So all that money chasing a limited number of AI shares, it isn't limited because the supply is just going to arrive. They're just going to keep pumping those shares out. And it's arriving right now, by the way. Anthropic, the company behind Claude, started the process of going public back in June. OpenAI, who make ChatGPT, filed about a week after them, and neither of them has given an exact date, but they're probably going to IPO pretty soon. But SpaceX already did it. SpaceX, Elon Musk's rocket company, had an IPO in June at a valuation of $1.77 trillion. That is absolutely absurd. It's a crazy amount. An IPO, by the way, is an initial public offering, which just means the first time anyone outside of the company can buy shares. It was the biggest one in history, by the way. At launch, each share was priced at $135. It peaked at $226. It's now down about 50% from that high. Almost everyone who bought the stock is down. A few days ago, 911.5 million more shares got unlocked. Let me explain what that means, because it's absolutely insane. When a company does an IPO, they release some shares, but most shares are locked, so early investors can't immediately dump their shares on retail. Because imagine you're an early investor, right? You have a bunch of shares, it IPOs, you dump them on retail. You're not allowed to do that. It's not great. Well, the unlocks have already started for SpaceX, 911.5 million shares, and obviously when insiders get their shares unlocked, what do? They sell them and they make profit, and price crashes. That is Dalio's second mechanism in action, and it's happening right now. It's happening with SpaceX, but it's going to happen with Anthropic, with ChatGPT, with all of them. And it's happening every day with all these AI companies because they're always releasing more shares. All right, so I've explained this interview a lot. Now, let me explain what all of this means, because what we learn from it is what is important. So question number one, do you just sell everything then? Do you go to cash and wait for it to come back when it's cheap? Dalio says that that's the worst thing you can do, and I agree with him. And this is where it gets uncomfortable for the doomer crowd. His words are, cash is the worst investment over a long period of time because inflation will eat it away, which is obviously true. The latest inflation numbers in the US came in at 3.5% for the year. So money sat in cash loses about 3.5% of what it can actually buy every year, whether you look at it or not. Now, you'll say, hang on, I get interest on my cash. You do. And the interest roughly matches inflation. So at best, you're just kind of standing still. You're breaking even. Then you pay taxes on that interest, and that's where they get you. So let's do the math with a real number. Say you've got $10,000 sat in there. You earn about 4%, so $400. You pay tax on that. So call it $300 cash in hand in interest from your $10,000. And then inflation took about $350 of purchasing power out of that pile. So you're down $50 and you did everything right. $10,000 saved in the year 2000 is worth around about $5,000 now in terms of what you can buy. So inflation just sucks. It eats away at your money. That's the price of sitting all the way to the left of that slider that I talked about. And the reason people happily pay it is because it's kind of invisible. That $10,000 sat in your bank is just going to stay there and feel like it's still $10,000. It's still $10,000 sat in your bank, so it feels like you've lost nothing. It's only when you go to spend it that you realize how little you can buy with it these days compared to 20 years ago. Okay, so we can't sell everything and move the slider all the way to the left. How about we go all the way to the right? The other end costs more, and it costs it a lot faster. Dalio said on these cycles, direct quote, that they go down 60 to 70%. And we saw that when the NASDAQ went down 78% during the dot-com bubble. Now, a 60% fall is not really a 60% problem. And this is the math that really catches everyone out with investing. Take that same $10,000 that we talked about. If it drops 60%, you've got $4,000 left, which kind of sucks. To get back to 10,000 from 4,000, you don't need to earn 60%. You need to make 150%. The math on big drawdowns is absolutely brutal. Now, the answer to all of this, and I know because someone is already typing it, is that no worries, you just sell the top, right? You just sell the top, of course you do. But Dalio has an answer for that too.
I would also say something. The future is very unknown, and people should not be timing. Sophisticated investors have a real challenge even in timing a bubble. So the important thing always is to diversify.
So that's a man with decades of experience, a full research team, and hundreds of employees, and he can't guess the top. So normal investors stand absolutely no chance, let's face it. So basically, at both ends of the slider, you're completely screwed. If you're all out and you just have cash in the bank, you're losing money to inflation. If you're all in, you're gonna have to eat a 60 to 70% loss at some point, or even a 78% loss if the next bubble is as bad as the dot-com bubble, where the NASDAQ lost 78%. Like I've said a bloody 100 times in this video, I'm sorry. So what do you actually do? That's the important question. Well, the first thing is you can't invest like Ray Dalio, and neither can I. Like I said, he's got hundreds of employees and access to data that we can only dream of. Also, he's managing billions for the mega rich. He's not just a guy managing his own retirement fund. So let's talk about Dalio's portfolio, and then we'll talk about my portfolio, which is a simplified version of his, and it's historically done pretty well, just like his. Dalio's all-weather portfolio looks something like this: 40% long-term bonds, 30% stocks, 15% intermediate-term bonds, and 15% gold and commodities. Now, it's important to note that the actual portfolio is probably a bit more complicated, but this is the essence of his all-weather portfolio. My portfolio right now is not too dissimilar from that. I've got 40% bonds, 30% stocks, 30% gold and silver, and some other metals. Although I'm planning to deploy a chunk of that 40% that I have in bonds right now into stocks and maybe into metals. But as you can see, my portfolio is pretty similar. It just suits my needs a little better. Now, I do believe the AI bubble is going to pop, much like Dalio does, but that doesn't stop me from having AI exposure. That 30% of my portfolio that's dedicated to stocks has AI exposure in it, just not directly in the AI companies itself. At least not yet, but I might buy some of them when they pop. It's more the picks and shovels of the AI race that I'm invested in right now, the power companies. So if we go back to that slider I've been talking about, I'm slightly to the right of the middle, Dalio is slightly to the left of the middle, and that's how you have to think about a portfolio. You can firmly believe that the AI bubble is going to pop, but it's not black and white. It's not all in or all out. I still want AI exposure because it might keep running for a while. It might keep running for a few years. You never know. I just don't want direct exposure. I want indirect exposure because indirect exposure rises with AI, but it doesn't get killed as badly when the bubble finally pops. If you're 25 years old though, and you're 30 years away from retirement, you're 30 years away from needing that money, then you might be further to the right on the slider. If you're 65 and you're retired already, you might be way further to the left. You might have cash in government bonds, plus some gold and silver. Pretty nice setup at that age, really. So where does that leave you personally? Well, you don't have to pick a side right here. That's the bit that everyone gets wrong about this, and it's the reason that this argument never really goes anywhere. What Dalio says is that the bubble is a matter of degrees. So what you do is a matter of degrees. Sitting all the way out charges you about 3.5% a year in interest. We've already talked about that. Sitting all the way in, 60 to 70% when it turns and the AI bubble pops. Where you sit in between comes down to two things: how long you've got before you need the money and how much of it you can afford to lose. And nobody can do that calculation aside from you. But if you want a proper framework for working that out, I've made a free guide on how to retire by 2036. It's linked to below. It costs you nothing and you get on my free weekly newsletter with it. It's great, it's free, so check it out. Now before we go, I have one question for you. Where are you sat on that slider right now? Let me know below. I'd love to know. I try to respond to every single comment. I'll see you in the next one.